As we mentioned earlier, there is no requirement or supervisory expectation that creditors must write qualified mortgages. It's strictly up to you as a creditor whether you wish to write non-QMs or QMs. We'll just briefly review what it takes to make a QM. The requirements for QMs that are spelled out by the CFPB in Regulation Z can be broken down into two basic categories: loan feature restrictions and basic underwriting requirements. Additionally, there are special QM rules for VA loans published by the Department of Veteran Affairs, and HUD has established QM standards for FHA-insured loans and certain HUD-guaranteed loans. Since the HUD and VA QMs are limited in scope, we will not discuss them today. Instead, we'll concentrate on the more broadly applicable QM rules that are in Regulation Z, with a special emphasis on the type of QMs we'll call the small creditor portfolio QMs. Now I'll turn it over to Glenn to tell us about the different types of QMs.
Thanks, Serge. The types of QMs described in Regulation Z are the general or standard QM, the special temporary government or government patch QM, the small creditor portfolio QM, the temporary small creditor balloon payment portfolio QM, which will be available until January 10, 2016, and the small creditor balloon payment portfolio QM, which after January 10, 2016, will only be available to small creditors operating primarily in rural or underserved areas. We will not focus on the rural underserved balloon QM because there is no requirement that the small creditor primarily serve rural or underserved counties in order to be eligible to make balloon loans until January 10, 2016. The CFPB has said it is reviewing the definitions of rural and underserved in the meantime to determine if it should propose any changes. We expect that many of our community banks that choose to write QMs will use either the government QM or one of the small creditor QMs, but we'll start with the 6 requirements necessary to make a general or standard QM. That will make it easier to understand how the other QMs made some accommodations for creditors, especially small creditors. For those of you who want to demonstrate compliance with the ATR rule by writing a QM, understanding the similarities and differences among the various types of QMs will help you decide what types of QMs to offer and which among them may be most appropriate in any given case, considering your business model and your customers' needs. Now I'll pass it over to Elizabeth to talk about the requirements for a general QM.
Thanks, Glenn. There are 6 requirements in the rule for the general QM. The first 3, relating to loan features, are: 1. The loan must provide for regular, substantially equal periodic payments. That is, there can be no interest-only or negatively amortizing repayment terms, nor can the general QM have balloon payments. 2. The maximum loan term is 30 years. 3. The total points and fees are capped at 3% for loans of $100,000 or more. There's a sliding scale, with higher points and fees allowed for smaller loan amounts. In addition to the tiered higher caps for smaller loans, many common upfront charges may be excluded from the 3% calculation, at least in some circumstances. These include fees such as appraisal fees and title-related fees paid to unaffiliated third parties, as well as bona fide discount points. We'll return to the subject of points and fees in segment 6 of this video to highlight some of those exclusions. The remaining requirements relate to underwriting standards. As is the case with non-QMs, you must verify the information using reasonably reliable third-party records. Just as we discussed in our segment on the 8 factors for underwriting non-QM loans, these so-called third-party records may include the bank's own records relating to the consumer borrower. Look in the regulation itself for examples of the types of records that can be used for verification. For the 4th requirement, you must determine the monthly payment to use in making the underwriting decision according to certain standards. As with the non-QM standards, it must include all mortgage-related obligations, including all taxes, and required insurance costs. There are also rules for how to calculate the principal and interest portion of the payment amount to use in underwriting, when the payment amounts could change or are uneven. As we mentioned in connection with this factor in the non-QM context, we'll explain the calculation rules later in this presentation. 5. You must consider and verify the consumer's income or assets, current debt obligations, alimony, and child support obligations. The assets must be something other than the dwelling. For purposes of this general QM, and only this type of QM, you must use Appendix Q, a new appendix to Regulation Z, to calculate income and debt obligations. For those of you familiar with FHA lending, it may be familiar to you. If there are gaps in Appendix Q, you may use guidelines from the GSEs, Fannie Mae and Freddie Mac, or relevant insuring federal agencies, unless they conflict with Appendix Q. 6. The maximum back-end debt-to-income ratio is 43%, with debts and income calculated according to Appendix Q standards. Appendix Q has specific guidelines for calculating debt and income to make sure that where the 43% DTI requirement applies, it's calculated consistently among creditors.
Thanks, Elizabeth. We know that many lenders have been concerned that Regulation Z's 43% DTI and Appendix Q may be too restrictive. Other QMs address this concern by not containing these requirements. So let's turn now to the small creditor portfolio QMs. We described earlier the asset and originations thresholds used to define a small creditor. There is an additional requirement to be eligible to write one of the small creditor QMs, and that is you must hold that loan in portfolio for at least 3 years, subject to some exceptions. We will not go into the detail of those exceptions in this video, but you'll find them explained in the CFPB's Small Entity Compliance Guide. Next, Glenn will discuss the special small creditor QMs.
Thanks, Serge. Let's compare each of the special small creditor QMs to the general QM. First, let's look at the small creditor portfolio QM. As you can see in the charts, the first special small creditor QM is essentially the general QM, but without the 43% DTI limit, thereby eliminating the need to use Appendix Q to calculate debts and income. While you must consider and verify DTI or residual income, you are not limited to the 43% DTI limit. Everything else is the same. Now let's compare the temporary small creditor portfolio balloon QM to the general QM. We know that many of you have been concerned about your ability to write balloon QMs, since the general QM does not permit balloon payments. However, as you can see in the charts, qualifying small creditors can continue to write balloon loans that have QM status. And the 43% DTI cap does not apply to this QM. There are some limitations on the terms of a balloon payment QM. It cannot have interest-only or negatively amortizing features. There is a minimum 5-year term and a maximum 30-year term. As with other Reg Z QMs, the points and fees limit applies. Additionally, the loan must be a fixed-rate loan. The periodic payments required by the loan must be substantially equal and based on a maximum 30-year amortization period. And there's another thing to remember about underwriting the small creditor balloon payment QM. You underwrite to the periodic loan payments and mortgage-related payments. You do not have to underwrite to the balloon payment itself. Again, we'd like to emphasize that any small creditor can write a balloon QM regardless of the geography it serves until January 10, 2016. After that date, this special balloon QM will be available only to small creditors operating primarily in rural or underserved areas, unless the CFPB makes further changes. Finally, there is a special temporary government QM. This is another option for banks that write conforming loans eligible for sale to the GSEs, Fannie Mae or Freddie Mac, or loans eligible to be insured by the Rural Housing Service or guaranteed by the U.S. Department of Agriculture. Let's compare this QM, which we're calling the Government Patch QM, with the General QM. As you can see on the slide, the first three loan feature limitations of the General QM also apply to the Temporary Government QM, including the points and fees cap applicable to that loan amount. However, the QM underwriting rules, including the 43% DTI limit, do not apply. Instead, you look to the relevant federal entity's standards for the underwriting requirements. If a loan is eligible to be purchased by one of the GSEs, it can have QM status, even if you do not actually sell it to one of the GSEs. This special QM is a temporary one, designed to provide extra transition time to the market. The GSE-eligible QM expires when Fannie Mae or Freddie Mac are taken out of conservatorship, or on January 10, 2021, whichever is earlier.
Thanks, Glenn. You can also write a special government QM by writing a loan that is eligible to be insured by the Rural Housing Service or guaranteed by the U.S. Department of Agriculture, USDA. Again, the loan only has to be eligible for the insurance or guarantee. It does not actually have to be insured or guaranteed. Though these agencies have the authority to write their own QM rules, as of the date of this video, they have not done so. If either of them does so in the future, you will use that agency's rule, not Regulation Z, to determine eligibility. If these agencies have not issued their own rules by January 10, 2021, their eligibility for QM status will also expire then. Finally, HUD and the Department of Veteran Affairs were also given authority to write their own QM rules. As we mentioned earlier, both of them have done so, so QM status is determined by those rules, not by Regulation Z. So those of you who write FHA insured loans or HUD guaranteed loans under the Indian Housing or Native Hawaiian housing programs should look to HUD's QM regulations. For VA loans, apply the Department of Veteran Affairs QM rule. Each of those agencies now have their own QM standards, and we will not cover those standards today. We provided the citations to the Federal Register for these rules on the slide. Now we'll move on to Segment 6, where we will discuss what charges count towards the QM points and fees cap.